Okay, this is problem P2-2A found in your textbook. In this problem, we're going to analyze transactions. We're going to journalize them, and then we'll post them to the T accounts or the ledger. And then from that, we'll prepare a trial balance. So why don't we start? I'm not going to read the problem. Hopefully you read it already. But on May 1st, Kent invested $25,000 cash. So I want to record this transaction. I've got cash coming in. That means I want to increase cash. Cash is an asset. If I increase an asset account, assets are on the left-hand side. Left means debit, so I will debit the cash account by this amount. I have my first entry right here in Excel. So let's see, just have to change this to be automatic. All right, so there's our debit to the cash account. And then what I want to credit is the owner's equity, and my credit will be for $25,000. So there's my first transaction on May 1st. I'm going to debit cash by $25,000, and then I'll credit the capital account for $25,000. The capital account is an account listed in the owner's equity section, right? Owner's equity is on the right. Capital increases owner's equity. If I want to increase a owner's equity account, right means credit, so I'll credit it. Notice this transaction, my debits equal my credits. Okay, let's look at transaction number 2. In number 2, we hired a secretary receptionist at a salary of $2,000 per month. What transaction would we make there? And that would be nothing, right? We will not make an entry. It's not a transaction. We just hired someone. We don't owe this person anything. They did not start working for us yet, so there's no liability there. Okay, let's see transaction 3. We purchased $2,500 of supplies on account from Reed Supply Company. As I told you before, if you watch the PowerPoint, when you see purchased on account, I know I'm going to credit accounts payable. That means I'll owe someone something. We received the goods, we received the invoice. I'm going to set it up so that I will have to pay them in the future, but right now it's a liability. Liability accounts are on the right-hand side of the equation. Right means credit, so I'll credit accounts payable $2,500. But what do I want to debit here? Right, it's telling me that I purchased $2,500 of supplies. Well, supplies is an asset. So the asset account that I want to debit, meaning increase, will be the supply account. Now, if you notice, with this problem, they did give us the chart of accounts. So you knew which accounts you had readily available in order to debit and credit. Right, and I will do the same thing when you take the test going forward on any of these chapters going forward now. Not for the test on chapter 1, but for the test on chapter 2 and forward. I will give you a chart of accounts so you'll know what accounts you have available to debit or credit. All right, so there's our transaction for purchasing supplies on account. All right, whenever you see the term purchase on account, that means I'm going to credit accounts payable, and then you want to look at the transaction to see what you would have to debit. All right, let's look at the transaction on May 7th. We paid office rent, $900 cash for the month. Okay, paid cash. I know I'm going to credit my cash. I want to reduce my cash account. Correct? Cash is being reduced. Cash is an asset. If I increase an asset account, I would debit it. If I want to decrease it, I'll do the reverse and credit it. So I'm going to credit cash for $900. Now, what would I debit? Let's see. On the 7th, we paid office rent. So I have an expense. Rent expense for the $900. Expense would be a debit. Anytime I want to increase an expense account, I'm going to debit it. remember, go back to that accounting equation um, so that you can get set in your mind. If you want to increase a certain account, what do you do? If you want to decrease a certain account, what do you do? All right, on the 11th, completed a tax assignment and billed the client $2,100 for services provided. All right, so I billed a client. That means, and I provided the services. So I earn the revenue and I'm going to bill them. Anytime you see those words, bill the client, that means you're going to debit accounts receivable. Accounts receivable is an asset account. Asset accounts, if I increase them, I'm going to debit it. Accounts receivable just means that this is something that we will be receiving. This client now owes us this amount of money, and I want to keep track of that until they actually pay me. But right now, this is something that's due to me. It's a receivable. I should receive this money in the future. Okay, and what I want to credit, well, let's see. We provided services. Services, that's revenue. So if I want to increase a revenue account, revenue accounts are part of owner's equity. Because they increase owner's equity, they will follow the same rules as owner's equity. An increase, let's see, owner's equity is on the right side of the equation. Right means credit, so that's what I'm going to credit, is the revenue account for $2,100. Okay, let's continue. On May 12th, we received $3,500 advance on a management consulting engagement. All right, so I received an advance, received $3,500. Okay, cash is coming in. If I want to increase cash, what am I going to do? Hopefully, in your mind, you said debit. All right, so I'll debit cash by $3,500. But now it's telling me I received this advance. So I haven't earned this revenue yet. It's a future revenue source. I do not want to affect my income statement with revenue and expenses, right? So I do not want to record an increase in revenue. This is a service that I will provide in the future, but I haven't yet. I have not earned that revenue. If you saw the PowerPoint, I went through an example like this. So what we would credit here is a liability account, and it would be the unearned revenue account. Right? Unearned. When you see that in a title, you know it's a liability. If I want to increase a liability account, liabilities are on the right side of the equation. Right means credit. So I'm going to credit this account if I'm going to increase it, and that's exactly what I'm doing. Unearned revenue. And what that means is it's a liability account, so I will have to owe this person the money if I do not provide the services that I've contracted to do. So I haven't performed the services yet. Right now, at this point in time, May 12th, if the client comes to me and says, you know what, I don't want your services, I want my money back, that money is due to them. I did not provide the services yet. It's a liability. Until I actually provide those services, it'll remain as a liability to that client, a money owed to that client. Okay, let's just do one more and then let's see, I'm going to look at May 17th. May 17th, we received cash of $1,200 for services completed on H. Arnold Company. All right, so I received cash for services that were provided for H. Arnold. Cash is being increased, so I'm going to debit cash. And then because we provided services, I am going to credit my service revenue account for the same amount. So service revenue is a credit of $1,200. Okay, I'm going to stop here. This is part one. We'll continue with part two.